Good afternoon, everyone. Welcome to the CMHA First Time Homebuyer Informational Seminar. My name is Dean Johnston. I'm a mortgage loan officer with Fifth Third Bank. In April of this year, I will be celebrating 35-year anniversary of helping people find and brings me great satisfaction. So this seminar is all about folks. Some of the basic steps that should be taken into account to get to the goal of owning a home. Owning a home is probably one of the most gratifying events for people that they can experience in their lifetimes. Owning a home is not meant for everyone, though. There are pluses and minuses to owning a home, just as there are pluses and minuses to renting. So this presentation is about understanding the pluses and minuses of owning. If you're thinking about buying a home or trying to prepare for a home purchase, the do's and don'ts of buying, what you can expect from a lender, because I presume that you're all here because you don't have the cash to purchase a home. So the only other way to purchase a home if you don't have the cash is to get a loan, what we call a mortgage. And some of the steps that you can, some of the things that you can expect during the loan application process, pre-approval process, and making the first step today. So what are the advantages in owning versus renting? One of the first advantages is it's one of the easiest ways that somebody can get an asset and have an asset that appreciates. And we have this word called equity. You get to build up equity when you own a home. Equity is the difference between what something may be worth and what is owed. So, for instance, if you had a $100,000 property that was worth $100,000 and you owed $95,000 on a mortgage, well, you'd have $5,000 effectively in equity that's sitting in your house, sitting underneath you. And the more equity you have, well, that helps you with wealth accumulation. Because for the most part, residential real estate appreciates, which means it goes up in value from year to year. And in Northeast Ohio, just like in many other parts of the country, we have seen significant increases in values of homes. So that's a good thing. Yet, if you're thinking about buying, you have to be prepared to understand that what somebody may have paid for a house 3 or 4 years ago, and that same house today, if it was put on the market, it's going to be worth more. So it's going to cost more for anybody interested in purchasing. The question is, when do you want to get on the merry-go-round and start seeing what's out there from a price standpoint and what you can afford? And is it time for you to get off the merry-go-round and say, yeah, I'm ready to buy and at this price range? The advantages of owning a home are, again, it's what everybody dreams of, to have a place that you can call your own, a place that you can manage and live in the way that you want to, versus if you rent. There are more rules and regulations about what you can do to the property if you're renting, versus if you own. As long as what you're doing is relatively legal, there are many things that you can do to your property, and nobody can say you can't do that because it's your property. But with that, with owning your own home, you can expect that you are responsible for the maintenance and the upkeep. So one of the nice things about when you rent is if something breaks in the house or in the apartment, the landlord's responsible to fix it. You don't have to pay for it. When you own a home, you are the landlord to yourself. If something breaks, it's you and if whatever breaks is of importance to keeping you safe and sound, you're responsible for paying for the repairs. So, for instance, you know, furnaces can be very expensive to replace. If you like air conditioning, same deal. Roofs do at some point wear down, and you need to replace a roof. Replacing a roof these days has gone up significantly because of inflation, because of construction and labor costs. And these are all things that you need to go into the process of home buying, understanding that you're going to be on the hook for this. And are you going to be in a financial position to quickly fix whatever is broken, especially if whatever is broken is about your health and safety. We're just finishing up one of the longest cold spells that we've experienced in Northeast Ohio over the past two plus months. Yeah, there's nothing like on a Sunday afternoon when all of a sudden, this was a few weeks ago, when I realized that my furnace was not working, and I'm going through my worst case. It's a late Sunday afternoon, so trying to get in touch with somebody. I'm thinking about who do I know? You know, what contractors do I know that are going to be willing to come out on a Sunday late afternoon, early evening? And I'm sure these contractors are pretty busy. Blah blah blah. So I got lucky because I do know people. I've been doing this for so long. And thankfully, my only cost was to replace a thermostat. It was not a furnace or a major furnace repair. But guess what? That was $330 on the barrel. You know, I had to pay the gentleman who solved my problem and who had a thermostat. And as far as I was concerned, I got away cheap. That's I was very thankful that I only had to pay $330. Uh, and other parts, if you're looking at the disadvantages, is you own the home, you have to pay property taxes for the house. You're paying taxes to whatever county you're living in. This is February, and if you purchase a home in Cuyahoga County, you can expect that you'll be responsible for the tax bill that's due on February 19th and on July 19th. Taxes are paid every 6 months. The good news is when you get a mortgage, for the most part, most people put their taxes and their insurance into their house payment. So you have a house payment that covers the principal and interest, which is the amount of money that you owe the bank every month, and the real estate taxes and the homeowner's insurance. So every 6 months, most people, if they have a mortgage on their house, most people are hit with a tax bill, and it's due in full for that 6 month period. And when you have a mortgage, the bank or the mortgage lender will pay your taxes for you. So they get the tax bill. So Fifth Third Bank will get your tax bill. We go into an escrow account that we set up when your loan closed and that you're paying into every month. Every month you're paying the principal and interest, you're paying the real estate taxes, and you're paying your homeowner's insurance. Once a year, your insurance company that you decided that you wanted to use when you bought the house, so you have the choice of who the homeowner's insurance is going to be with. Once a year, the insurance company is going to be paid. And just like the county that sends us the tax bill, your insurance company will send us the renewal insurance policy so that the homeowner's insurance can be renewed for the next year. We'll go into the escrow account that you were paying your real estate taxes into, that you're paying your principal and interest, and that you're paying your mortgage homeowner's insurance. And we'll pull out 12 months worth of homeowner's insurance, and we'll send it to your insurance company, and your house will be insured for the next year. So again, it's an advantage when you do the one stop and shop. Your total house payment includes the taxes and insurance instead of having to pay your taxes every 6 months, and pay your homeowner's insurance once a year. So it eliminates you having a huge bill a couple of times out of the year if you have your house payment, including the taxes and insurance. Uh, it is not mandatory that you pay your taxes and insurance on your mortgage. If you are a 20% down purchaser, so you put 20% down and you get a conventional mortgage, uh, you don't have to pay your tax and insurance with your house payment. You do have the freedom, if you choose, that you can handle the tax bill when it comes due every 6 months, and you can cover the homeowner's insurance. Uh, Again, that's a function of the type of loan that you get from the bank. If you get an FHA mortgage, a VA mortgage, if you get a conventional mortgage where you're putting less than 20% down, you don't have the choice of taxes and insurance being paid separately. It's going to be built into your house payment. There are pluses in mind. There are potential tax benefits to owning a home. They're not like they used to be, so I'm not going to go into what those tax benefits are. For the most part, in the price range that you folks are going to be purchasing, and based upon your income, your accountant or whoever prepares your federal tax and state tax returns, they will determine that the write-off for your owning a home is not worth writing off. You'll just take a standard deduction and you'll get the most back on a refund. So this is, trying to do a comparison, a cost, apple to apple comparison of the financial benefits of owning a home. These numbers are these numbers. Just take them with a little bit grain of salt. It's based upon numbers that were decided for this presentation. But in most examples, no matter what the house payment is versus what the rent is, when you look at the cost savings to yourself from a cash flow standpoint and from an appreciation standpoint, you're going to save money even in today's market if you own a home versus if you pay rent. So even though there's going to be costs associated with paying the house payment and paying the taxes, if you compare that house payment to what you're paying in the equivalent amount of rent, you're going to save $1,000 a year in cost savings by owning a home and paying a principal and interest payment. Sometimes during the loan application process, we send out disclosures and we let you know this is the cost of the financing. This is how much if you purchase a home and stay in the home for 30 years and pay a house payment for 30 years. So you'll see this large number of if you just make your regular house payments for 30 years, you'll see that you could pay back the lender between what you borrowed and the interest that you paid over 30 years. It's going to be a number that, depending upon the original sales price and the original loan amount, it's going to be a number that's going to be anywhere from $300,000 to $500,000 over 30 years if you don't pay that loan off early payments. I like to point out to people when they see that and they say, "Oh my God, I can't believe I'm going to pay this much over 30 years." The best response I have for that is, well, if you do the math and you looked at how much you paid in rent for 30 years versus what you paid for 30 years on a mortgage, you're still a couple $100,000 ahead if you get a mortgage versus paying rent every month. The dues of buying your first home. Well, the first thing, and one of the things I help people just like you do every day of the week, is if you're serious or if you're thinking about buying a home, you need to get pre-qualified / pre-approved. Uh, Number one, no real estate agent is going to take you to go visit houses that are available for sale unless you have a formal pre-approval from a lender. Uh, with all due respect, they're 100% commission professionals. They're going to spend hours and hours, showing you houses, sending you information. They want to have some assurance that you'll be approved for the loan. And the only way they can get that assurance is by you presenting them with a pre-approval letter that you've received from a bank or a lender. And that pre-approval process is just simply submitting an application to a lender, and we're going to obtain from you the employment information, how long you've been employed, what your income is. As you well know, one of the most important parts about getting any kind of loan, much less a mortgage, is your credit. So the pre-approval process will determine what your credit scores are that are reported by the 3 credit bureaus. The credit report will be issued to us, which will show what your history is. So credit is one of the things that sometimes people have to do research into on their own and with their lender. And if there are challenges or potential issues, it's better to know about them now and come up with a game plan to fix that credit, and so that you're presented with a stronger credit score and a better credit history that can then be used for a formal pre-approval. One of the first questions out of my mouth for most of my clients, and doesn't matter to me if you're a first-time home buyer or if you are you've bought and financed multiple homes over your lifetime. First question out of my mouth is, where are you thinking about buying? Do you have any idea what price range interests you? Have you done some window shopping? Do you have some idea of what price range interests you? And excuse me, having a mental block. Oh, and what do you want from a house payment standpoint? So I ask customers all the time, do you rent? How much do you pay in rent? Oh, you pay $900 a month in rent. How would you feel? Oh, you're thinking about buying in this community at this price. I'm going to guesstimate that's about a $1,400 a month house payment. Do you think you can handle a $1,400 a month house payment? Do you want me to run numbers for you? A $1,400 a month house payment, a $1,200 a month house payment, and we can determine what price range you should really be looking at. Again, you need to be real. Once you have the numbers from a professional like myself, you need to be realistic in what your needs are versus what your wants are. And maybe what you want may be out of your price range or out of your comfort range. And you need to just be realistic and honest, say, all right, I may need to take a step back. Maybe I shouldn't even be buying a house right now. Maybe I should see if I can earn more money, get a different job, or no, I can go with a lower house payment. This is just the first step, and it'll be affordable to me, and I'll just use this house payment or this particular house as a stepping stone. It's not going to be my dream house. I've got time to establish myself so that I can be in a position to buy my real dream house, so to speak. Again, one of the reasons why you're on this presentation with us is because you're thinking about buying a house and you'd like to know what types of programs are available. There are so many mortgage programs available, both at the private level, that's banks, and at the governmental level, that's also banks, and that's also state agencies, that's also local agencies. So coming up with the money that's required for a down payment does not have to be exclusively something that you have to do. You still have to meet minimum down payment requirements for most loan programs, but depending upon your income, depending upon where you want to purchase, there may be down payment assistance and closing assistance programs that are available. And most lenders like myself are well aware of what they are. And it's my job to try to fit you into the best product and best program based upon what you're qualified for, and also based upon what you're looking to obtain from a house payment standpoint and from a sales price standpoint. Basically, once you've been pre-approved for a loan and a price range, that's the time that you enlist the other professional that's so important in the home buying process. Estate agents, they're the pros. It's their specific things about neighborhoods, how this price versus if you go at a high price or a lower price. Do you want a two-car detached garage or a one-car attached? That's where the real estate agents come into play. They've got a wealth of knowledge, a lot of access through the internet, and most of them know the communities and the clients that they want to serve, and they serve them well. So you hook up with a real estate agent and say, "Hey, look, I got a pre-approval from Dean Johnston, Fifth Third Bank." Most of the real estate companies recognize the pre-approval letters. Lenders send them out regularly. Mine may not be the same as New York Community Bank, but if it says the right things, then the real estate agent is going to say, "Great, you got a pre-approval." It tells me how long you pre-approved for, 120 days. It shows the sales price. It shows the loan amount. And even though you may not purchase at that sales price or that loan amount, they have some idea of what your maximum purchase price can be. And that's going to be on the pre-approval letter. Some lenders have pre-approval letters that are only good for 90 days. Fifth Third Bank, we're good for 120 days. And basically, once we issue that pre-approval, we're not going to change the credit report that helped us to issue that pre-approval. After 120 days, that credit report that we utilized to issue your pre-approval, that credit report expires. And if you want to get a new pre-approval letter, you just request from me or the lender, say, "Hey, I want to update my pre-approval letter, make it more current." And as long as if you've had a job change or you've run into some money, that may be stuff you want to share with somebody like me for my next pre-approval. And if something's changed on your credit report, I'm going to need to know about that. But eventually, if you give me authorization to issue that pre-approval, I am going to pull a new credit report, and that credit report will be good for another 120 days. And that's how you keep your pre-approval alive if you want to. In Northeast Ohio, besides having a real estate agent, you could, if you so desire, hire a real estate attorney or an attorney who specializes in real estate. It is about 95% of all transactions that I'm involved in. They don't involve a real estate attorney. They use real estate agents. It's actually cheaper it's cheaper to use a real estate agent versus use an attorney. The real estate agent is licensed. They're licensed to conduct business in the real estate market. So they have to do their jobs as close to perfect as possible, or they put themselves and their license at risk. Once you purchase a home, one of the things that you may add into your purchase agreement is if you're going to get any form of a home inspection. It's strongly recommended that you hire an outside inspector to inspect the property. It's a 2 to 3 hour process, and the good inspectors are going to go through every nook and cranny and point out what they see, if there are any issues with the property. And if you so desire, you may be able to go back to depending upon the verbiage in your real estate contract, your contract may say that it's subject to a home inspection and buyer's acceptance of the home inspection. If the home inspection reveals things that you don't want to incur when you purchase the property, you can request that the seller uh, fix the problem that you see that you don't want to fix, you think the seller should fix, and or make some form of a concession in sales price or closing costs. Say that, all right, I understand that I'm going to need to fix this in a couple of months. Uh, in uh, for me accepting this repair that I will incur. I want you to reduce the sales price by X amount of dollars, or I want you to give me X amount of dollars of closing costs as pay my closing costs or pay a portion of my closing costs. Since down the road, I've got to reach into my pocket to pay for this inspection finding. Something else you can do, and that's part of the purchase agreement, is you can have, you can get a home warranty from an insurance company. It's not the same thing as home insurance. Home insurance is to protect the people in the house. It's to protect the roof if it blows off. It can be rebuilt if it takes a weather event. If somebody trips on your sidewalk and hits their head, that's where they can make a claim against your home insurance. So home insurance is to help protect the inhabitants, to cover unforeseen damage to the property or potential lawsuits for accidents. A home warranty is insurance to cover appliances. So you buy the house and the refrigerator breaks the next month. Washing machines, dryers, some of them do include furnaces. I'm not an expert on home warranties, so and the people who sell them primarily are the real estate agents. They have access to the home warranties, and they can hook you up with a home warranty that either you pay for at time of closing or the seller pays for at time of closing. Approximately 50%, it could be more, 60% of all transactions, the real estate agents work into the purchase agreement that the seller is to pay the home warranty, and it's only covering you for a year, and you can renew them too. Just checking the time. So, out of the people that you're going to spend the most time with, probably for the most part, when you purchase a home, is going to be the lender and then the real estate agent. The real estate agent's definitely going to spend a lot of time with you shopping and doing follow-up to purchase agreement language or things to ensure that terms and conditions are met by the seller and also by the buyer. But you're going to spend the most amount of time with somebody like me, because I want to be with you from the very, very beginning and till the very end. So during the pre-approval process, while you're out there looking at houses, you're going to be getting back to me saying, hey, this house, this address, these real estate taxes, $180,000, $150,000, $100,000 purchase price. What's my house payment going to be, Dean? And I want to be doing that for you 7 days out of the week, because a lot of times people see houses after normal work hours and on weekends. So I'm going to be with you for the pre-approval process and during the home shopping process. And as importantly, once you have a purchase agreement with an agreed upon sales price and a closing date, we're going to be generating a live, federally regulated mortgage loan application, and I will be coordinating between you and my back room, getting the back room the information that they need so they can issue you what is known as a final loan approval or a clear to close, so that you sign a purchase agreement on February 10th and you have to close. You're going to take ownership sometime in the middle of March. It's my job, and it's your job too, to help me, to help you get everything that an underwriter, who's the person who issues the approval, get everything that underwriter needs perfectly so that he or she can say, congratulations, here's a loan commitment for $150,000, 123 Main Street, any city, Ohio. Uh, so my part is to guide you through the process and to help you get the loan approved as quickly as possible. Uh, you're going to It's going to be disclosed to you in the initial part of the loan process, the type of loan program you're getting, and what additional documentation we may need from you, updated pay stubs, a divorce decree settlement agreement, proof that you have homeowners insurance. You're going to go out, you're going to contact your own insurance company and have them get you a quote for insurance. That insurance company is going to send me that quote. There are things that I have to communicate back to the insurance company so that at time of closing, the insurance policy is ready to be paid in full at time of closing. Uh, Shortly after you take your loan application, within 3 to 5 business days, you will have received our federally mandated loan disclosures. You need to review those disclosures. You need to electronically sign them or sign them in person, so to speak. And once those documents are signed, we are going to come to you and say, your closing costs are, and you'll know this because I'm telling you well in advance, but of your $8,000 in closing costs, $495 is an application fee that's payable to Fifth Third Bank. All banks charge application fees. It's part of their closing costs. It's very normal. You'll be required to pay us the application fee. And once we receive that application fee, we are going to order an appraisal on the property. An appraisal is not an inspection. It's similar to one, but it is not. But an appraisal, the primary purpose of an appraisal is for the lender to determine if the property is worth what the sales price is. Oh, I have a purchase agreement that says it's worth that it's being sold for $150,000. My loan is going to be based upon you putting a percentage down on that $150,000 in relationship to the down payment. Excuse me. Well, we're going to want to make sure the house is worth $150,000. If an appraiser goes out to the property and issues an appraisal that says the house is only worth $145,000, we are going to make our loan to you based upon $145,000, not based upon $150,000. So if the property is to not appraise at the full sales price, you will have a decision to make, and you will discuss this with your realtor too. Hey, I really like this house, but I don't want to overpay by $5,000. That's $5,000 extra that I have to come up with because it only appraised for 45. I want to go back to the seller and say, hey, I love your house, but it's only appraised for 145. Can you reduce the price to 145? I'm not making up the difference. And that happens with some frequency. Again, it depends. There's no norm for it. In the past few months, I've done a number of loans, and I can't recall the last one that came in with a low value. But that doesn't mean that the next one I get, the appraiser is going to come up with a value that's low. And this process of going back to the seller to renegotiate the sales price is going to be put in place. And the other thing about the appraisal, when I say it's an inspection, but it's not the same thing as a private home inspection, the appraiser is, again, Fifth Third Bank is never going to go into your house. It's just not the way banks operate. We're not going into your house at any time, either before you buy it or even after you buy it. The appraiser acts as if it becomes our eyes and ears. So when an appraiser goes to the property, again, the primary purpose is to determine, is the house worth what the purchase agreement is? However, When the appraiser is at the property, he or she is going to take easily 20 to 30 photographs. They're going to take photographs of every room. They're going to go into the basement, take photographs of the basement. They're going to take photographs of the furnace, the hot water tank, and the electric box. Uh, and all the bedrooms, some of the closets. If there's a crawl space between the ceiling and the roof, they'll go into the crawl space. If there's a garage, interior, exterior, or attached, detached garage, they're going into the garage. They're going to turn on lights. They're going to turn on water. They're going to take photographs. And so it is a form of inspection. Because if the appraiser sees anything that he or she believes affects the health, the habitability, the safety, the marketability of that property, the appraiser knows that they should disclose that to us, the lender, when they issue the appraisal. So even though it is not the appraiser's job to do an inspection anywhere close to a private home inspection, the appraiser's in the property for 10 to 15 minutes. He or she can wink through that house in a New York minute and photograph everything they're supposed to, versus a home inspector that's going to be there between 2.5 to 4 hours, depending upon the size of the house. But their purpose is to, hey, is the house worth what the sales price is, and just confirming that there isn't a health, habitability, or safety issue. Uh, and that can be an issue sometimes when an appraiser calls out that they see, the front step is missing a couple of bricks. The banister on the front step is loose, or there isn't a banister. It's 3 steps or more. And they will make their appraisal subject to either subject to fixing whatever they deem to be an issue. Sometimes they won't make their appraisal subject to. They'll leave it up to the underwriter at the bank. So if they submit these photographs, even though the appraiser may take a photograph of a front step that's 3 steps or more that doesn't have a handrail, he'll still take a photograph of it and then leave it up to the lender to determine, hey, they see the photograph. If it's an issue with them, then we will give notice. The appraised value is fine. However, this appraisal is subject to installing handrail on front step that's more than 3 steps. And that's being done to protect you too. Please know that. Our job is not to try to make your lives miserable or uncomfortable. Our job is to cover our hiney, so to speak, but also to protect the borrower, because we want the borrower, we don't want a borrower to move into a house and there's something obviously wrong with the house that we should have seen when the appraisal went through the house. And have you come back to us and then change your mind about it and say, hey, well, you knew you had a photograph of it. So it's to protect us, but it's also to protect you. And in that early process of your purchase agreement being submitted, the lender is going to, the real estate contract that you sign is going to require that you put on deposit with them or the title company that's doing the closing, what's called earnest money. And so it's typical in Northeast Ohio for a buyer of the house to have to put down a minimum of $500 or $1,000 or $2,000 down when the purchase agreement is finalized. And that money goes into a third-party escrow account. It can't be touched by any of the agents. It can only be released when the contract is ready to be closed. And then, and so if you have a loan or a contract that said you were getting a $100,000 house and you're putting $5,000 down, you are a 5% down buyer. So 5,000 is 5% of 100,000. And at time of purchase agreement acceptance, you gave $1,000 towards the purchase agreement into earnest money. Well, you just prepaid $1,000. So at time of closing, instead of you having to come up with $5,000 for down payment, you're coming in with $4,000. The title company is going to reach into the escrow account and then take that $1,000 and apply it towards your down payment. How are we doing for time? Probably. All right. Things about mortgages. Mortgages 101. You can look this information up on your own too. It's pretty standard and straightforward. For the most part, most of the mortgages that people are getting these days are fixed rate mortgages. Means your interest rate is fixed for the life of the loan. Your interest rate can never go up during the life of the loan. You can expect that your house payment will go up during the house of the loan. I mean, during the term of the loan, because as indicated, if your house payment includes real estate taxes and homeowners insurance, you can plan on your real estate taxes going up every couple of years, and you can replan on your homeowners insurance going up every couple of years. And again, when those payments go up, we get notice. We'll make the payment on your behalf, and then we'll come back to you and say, hey, your house payment's going up because your real estate taxes went up, your homeowners insurance go up. So that again, but you're always that rate, that principal and interest is fixed for the life of the loan. And versus an adjustable rate mortgage, which I don't recommend for first-time home buyers, which are still, again, they have the pluses and their minuses, but that is where your interest rate can go up during the life of the loan. There are terms and conditions about how much can go up when it comes up for adjustment. For the most part, for the audience that I'm talking to right now, you shouldn't have to worry about adjustable rate mortgages. Don't get an adjustable rate mortgage and just count on a fixed rate mortgage, at least for your first house payment. There are many types of programs out there that are in place to help customers with lower credit scores or with lower down payment requirements. That's Federal Housing Administration, which is one of the best mortgage programs in the world, as far as I'm concerned. And there's VA mortgages, which are for veterans, honorably discharged veterans of the United States. It's VA mortgage is a true zero down mortgage. One of the first questions out of my mouth to anybody I talk to who's thinking about buying a house is, are you a veteran? And I tell them that. I ask that question because if they are, they're going to expect that I would have asked that question. And they are going to maybe interested in taking advantage of using their VA eligibility and going zero down. They could put more than zero down, but they know that VA benefits have offers that other loan programs don't have. And since I'm a veteran, I'm always going to make sure that if I'm talking to a veteran, then make sure that veteran knows what's available. There are state programs. Fifth Third Bank does a lot of programs through the state of Ohio, which has a true zero down type of program too. They do FHA mortgages and conventional mortgages. It's called Ohio Finance Agency. A wonderful program, and I may explore those programs. All of these programs I'm going to be discussing with you as a potential borrower, somebody coming for a pre-approval. These are options that you have, and this may be the best option for you. That isn't part of our calculation. What's part of our calculation is gross monthly income, is if you have credit cards, what are your minimum credit card payments? If you have student loans, even if they're in deferment or forbearance, we're still going to hit you with a minimum amount of those student loans as part of your monthly house payment, a monthly debt load. If you have a car loan, a car lease, that's going to go into your debt load. If you pay alimony or child support, that's going to be calculated as a debt into your debt load, and vice versa. If you receive child support and alimony, we may be able to count that towards your income. And if you receive child support and alimony, by the way, your income will actually increase because we're allowed to gross up. So if you get $1,000 a month in child support is non-taxable income. So we can gross up what you receive by 25%. So we can actually create more income for you to qualify with. Uh, you don't need to know the exact way we do the calcs, but you need to just know that, again, if your debt load is too high, you can have the best credit in the world, the best credit scores in the world. We are still not going to issue you an approval possibly for the price range that you want. We may say, based upon this debt load, this is the most that we can approve you for. You're going to get, and after this seminar is over, the folks at CMHA have access to this presentation that I have, and a couple of other ones that they can email to you. Specifically, there's one on debt management, which is a new one that we just came out with. It is phenomenal. I strongly encourage you to take a look at that. It shouldn't be anything to be scared about, something that can really help you greatly. Also, I've included that right there. I can't even open it. I've included a first-time homebuyer counseling and credit repair counseling a flyer for local homebuyer and credit counselors that you can go to that can help you with credit analysis, credit repair, and also if you're close to thinking about purchasing a home, can get you into a first-time homebuyer counseling program that you may be able to utilize for mortgage programs for down payment assistance and closing costs. And I'm sorry if I ramble on. I am finished. I can see if there are chats that I can look at. I don't see anything in chats. So is this the NACA program like this too? Well, similar, yes. NACA is dedicated to first-time home buyers and credit repair. One thing I can tell you right now, and please believe me, I'm telling you this from the bottom of my heart. I'm a straight shooter. Do not pay for credit repair. Do not pay for credit repair. That's my personal opinion. You can fix your credit basically for free. You can hook up with the home buyer counseling groups that I'm giving you information on, and they can help you navigate your credit report and what you need to do to fix your credit report. Or you can reach out to somebody like me and say, hey, here's a copy of my credit report, or here's what's on my credit report. What do you think I should do? And some of the times, I'm going to tell you what you need to do is you need to get in contact. If you have outstanding collections, and if they were truly yours, you need to get in contact with those folks and work out some payment plan or reduce settlement. So you maybe instead of you paying them $300 at your home, you pay them $150, and they report on your credit report that the debt has been satisfied less than full. Or if it's something where you think maybe an attorney would help, you contact a credit attorney. Or if you think maybe bankruptcy is something that might serve you better right now, then you contact a bankruptcy attorney. And by the way, bankruptcy is a wonderful way for people to get off, to shed the yoke of bad debt. Again, corporations use bankruptcy. People can use bankruptcy, and you can get a mortgage 2 years after bankruptcy after Chapter 17 bankruptcy, 2 years after you get a bankruptcy, you can qualify for a mortgage very easily because your credit and people like me are going to say, cool, your bankruptcy just filed, great, or discharge. Now, let's start seeing you establish some credit. And this is what you're going to do with the credit. When you get the credit, you're not going to abuse it. Here's how you're going to use it. And I'll see you in 2 years. Get you a house. I need the one for debt management. Oh, yeah, I'll get it to you, Maureen, in a sec. If I could get off of this thing. Here. How do I get out of here? No other questions? Hang on, I lost my page. Yeah. No other questions? Speak now, forever hold your peace. Yeah, well, that's going to be, yeah, I'll get you that too, Marie. Right, and you have all the emails for the attendees, right? But for the people that are on the presentation, you'll be able to email them. All right, cool. So after we hang up, I'll email you the good stuff. It was really great. How many people were on this?